What's up, guys? It's the Flopping Groper, and today I'm just going to talk about bullish and bearish divergence. So this is our Bitcoin daily chart here, and I'm just going to demonstrate a few times where the price was disagreeing with the oscillators down below. Since that's what divergence is, guys, it's just a disagreement between what the candlesticks are doing and what the oscillators are doing. Therefore, you can't just be looking at the waves like this and see divergence. All you will see is whether or not an oscillator is overbought or oversold. You're not going to see any kind of comparison between these waves and the price action, which is what's required for divergence. Divergence is the comparison of the two. So, to spot divergence, you need to have both the price chart and the waves visible at the same time, and there's a couple rules you got to follow. First things first is if you're going to start a line down here, you have to follow this vertical axis all the way up to exactly where it was on the candlestick chart. You do not need to draw your lines from either the wick or the body. It's honestly subjective which one you do. You could do it from the wicks if you want. You could do it from the bodies if you want. This is honestly a subjective art, and it's up to your interpretation. Also, if we're going to draw, for instance, from this peak to this peak, we need to do this same distance down here on the wave. So we would draw from this peak to that peak, like that. So make sure that these horizontal distances are the same when you're drawing divergences. Make sure that you're comparing peaks to peaks, peaks to peaks, or bottoms to bottoms. For instance, from this point to this point. And then the point down here that you would compare that to would be, see, you follow this down and you go to this bottom and you can combine that with this bottom here. So what we've isolated here is two major divergences off the daily chart that played out rather beautifully. So this first signal that we see, this one right here, this is at a bullish hidden divergence. So what happened here is the oscillator created a lower low. You can see this is kind of like the opposite of a anchor and trigger situation. This is like a trigger followed by an anchor, right? How is this bullish? It's bullish because when you compare this to what the price did, the price actually created a higher low. And so if I were to compare this to a real life metaphor, basically right here, imagine that like you get punched. You're in a bar fight and you get punched, and it doesn't really hurt you that much. See this small wave here? It didn't really go that deep. So you get punched at a bar and you're not really that phased. And then the guy, he's shaking his hand off, and by the time he punches you again down here, now he's more into it and he punched you harder than before. However, do you see how you have even more strength? So since you already were unfazed by his previous punch, you've gone up here and you've built this strong level of support, and now when he comes at you with his sucker punch, it doesn't do anything. So, and then now that he's weak and expended his energy, now you can press the attack. Do you see this upward move that followed? So what this signal is this is called a hidden bullish divergence. It's hidden because it's actually a divergence that's in favor of the trend. So what I mean by that is the market was going up, and then we saw our divergence play out, and then the market continued up. So now it's kind of dipping a little bit, but basically we had this leg up right here and a leg up back here, and this was basically like a continuation based off of this hidden bullish divergence. So a standard divergence is actually a counter trend reading. So a regular divergence, such as this one right here, this is a regular bearish divergence. You can see how the candles created a higher high on the daily, but the oscillators told us that that price action was false, right? It's kind of like telling a joke 2 times in a row. You tell the joke and everyone laughs. You tell the joke a second time and not as many people laugh. The more you keep telling the same joke, the less power it's going to have. Do you see that? So don't make the room awkward. You know, when the situation gets awkward or cringe and there's too much FOMO, too much flopping and groping, basically it's going to happen after we breach a significant level such as this. When you breach this level, you reach this FOMO point, and basically no one's looking at the oscillators anymore, right? They're just trying to get as much gains as possible. And so the traders who catch these readings either get out before the gropers get wrecked, or they can see that if we were to zoom in on the smaller time frames, there's probably some smaller micro bear market conditions on the 1 minute or the 5 minute that you could take advantage of if you had the balls to short. So it's good to catch these signs when they print. Just to kind of give you guys a general overview of the different types of divergences here, we'll just draw them out right here for you. So you have two main types of divergence. You have bullish divergences and bearish divergences. So a bullish divergence is going to be comparing lows. Let's write that in here. Comparing lows in price to lows in the oscillator. So when you see a bullish divergence, what you're going to see is the price continues to go lower. You'll see this here. And then you see your oscillator, which is like swiveling around a bar like this. What the oscillator will look like is this. So we're going to come down like that. And then we're going to create a higher low. Do you see this? So what we're going to see here is we're going to see the price action going lower, but the oscillator going higher. The oscillator going higher. And that's going to give us a kind of upward bounce potential that we need to enter along if we're in a larger uptrend. So look for these whenever you are smelling a potential bottom in a market. Just be careful, because if you are in a bear market, or like you're on too small a time frame and it's just a bearish day, these long signals, since this is a bullish divergence, might not play out that well. So in that case, you might want to be looking for bearish divergences. So what's a bearish divergence? So a bearish divergence over here bearish divergence is comparing highs in price to highs in the oscillator. So if we saw the price coming up like this and the price goes higher, like what we saw on the chart before, but then you look at the oscillator and the oscillator is weaker, do you see how the price went up, oscillator went down? That's a standard bearish divergence. And so when you're in an uptrend and you see this, that's a great place to take profit. If you're in a downtrend, this is a great place to enter a short position. And so these are standard versions of each one. Now, where it gets confusing is standard divergences versus hidden divergences. So these are your standard divergences right here. Now there's also hidden divergences. So a hidden divergence is going to occur when the price actually is creating a higher low. So what we'll see is we'll see a low and then another low like this. And then what the oscillator is going to do is it's going to create a lower low in the oscillator. And so you're going to see this kind of formation like that. And basically what this is saying is, despite even more bearish momentum, the bulls are actually able to keep the price at an even higher level, which is almost going to act like a springboard for even more higher action in favor of the trend. So as you can see, a hidden divergence is in favor of the trend, whereas a standard divergence is a counter trend. You see here on this top example, we were headed down, and now this is telling us we're going to start heading up. Whereas in the hidden divergence example, we were already going up, and it's telling you we're going to keep going up. So what's going to happen over here with the hidden bearish divergence is we're going to create a lower high with the price, but the oscillator is going to create a higher high. And what this is going to create is a downward pressure scenario where the price failed to create a higher high and there's even more sell pressure pushing down on the price. So basically the market is going down and the momentum is telling us it's going to keep going down. Whereas with the standard bearish divergence, we were going up, but the oscillators are telling us that we're going to go down. And so hopefully this kind of diagram, I know this is like chicken scratch. You guys can Google divergence spreadsheets yourself and, copy and paste it to your bulletin board or whatever you got to do to remember this stuff. But just make sure you keep this in your head. So now that we did a little review of what each of the divergence types looks like, we can start looking for it on our chart. So we already saw those two big ones. Those ones were super obvious. Here we see, one of those textbook crypto face anchor wave, trigger wave scenarios here. You can see the big anchor wave followed by the trigger waves. When he talks about that, he's purely talking about the wave reading. He is making no mention of what the price is doing. So anchor trigger waves are not divergence. It's more or less just the wave reading part of a divergence reading, which is just reduced momentum trending back toward the zero line. So that's all the anchor trigger wave theory is momentum that's trending back down to zero. And that's how we know that one side of the market's getting tired and the other one's going to take over. Anyways, you can see here that we see some hidden divergence here where basically the price goes higher, but the oscillator goes lower. Do you see that? How we established support at an even higher level and we were given the momentum to trampoline ourselves up to another price level. That is a bullish hidden divergence. This upward move right here, the correction was already predetermined by this bearish divergence. You can see we pumped up, the price continued to creep up, and the momentum continued to fall. And it was only a matter of time before this price action dumped back down to that level there. That right there is a bearish standard divergence. Here's a little divergence here. You can see how the price went up, but you can see how on this wave we actually reduced in momentum there, showing us that the trend was about to reverse, at least for a short period. Back before the COVID dump, we saw some bearish divergence before the COVID dump. Funnily enough, the technicals had you trading in the right direction before the collapse occurred. You can see that the price crept to the upside, whereas the blue momentum waves failed to do so, and they created a lower high, which created a downward direction that the market was put into. One little caveat I would like to add is that a divergence can be weak, at least in my eyes. You might find traders who disagree with this, but I think that a lot of this is rather subjective. And so if there's a case like this where, price is holding a flat level and the momentum is trending to the upside here, like a miniature anchor trigger wave, this to me is, subjectively speaking, divergence. So what we would have loved to see is for these candles to go lower, whereas these waves go higher, and you've got that springboard for a big bounce. We didn't see that. However, for the price to remain flat and this oscillator to reduce, that to me is still a disagreement between the oscillator and the price. And so sometimes I will justify trades if either the waves or the price is flat, but not both, since that technically would be a minor disagreement between price and the oscillator. So try to read divergences as varying in magnitude. Some are weak, some are strong. They're either bullish or bearish. They're either hidden or standard. It's up to you guys to teach yourselves what all these mean and apply these. Because when you go into those minute time frames or 15-second time frames, these things are going to be firing off at you every couple minutes. So you got to know how to spot them. So one thing that divergences are really good at is telling you the direction of a market. They're not very good at telling you the magnitude of that movement. So this bearish divergence here that we saw that has still been playing out, there was no way to know if this momentum was going to curve up here and that this was going to be the dip right here. There's just no way to know that based off of these momentum oscillators. So basically, we're not going to know the magnitude of this bearish divergence until we get the counter signal from the blue wave. We'll get that little green dot at the bottom of the blue wave, similar to this that happened here. And that will be basically our measure of the magnitude of this dump that we're seeing. Until then, there's no way to know the magnitude of this dump. So all we know is the direction, and that is kind of a weakness of divergence. So for instance, right here, the price went up, the momentum went down, and we know from this point here that the price is going to go down. We just don't know how much. And so it didn't really dump that much here, but then it dumped a lot. So it's like you could have taken profit here. Depends how long you want to be in your trade. And this is like a couple days. So just beware, guys. Like sometimes you don't know how long these moves are going to play out. You can see this took an extra week before this short signal really played out and got you that counter signal down here. So results are going to be variable, but these signs are deadly if you do not see them. And hopefully this video helps you spot them. So thank you guys. You guys have a good one.